Welcome to Get Rich Education. I'm your host, Keith Weinhold. Savers are losers, debtors are winners. Could that be true? Well, that's a quote from none other than the greatest selling financial author of all time. We're going to break that down. And what do higher interest rates mean to your future as an investor? Today on Get Rich Education. MC Laubscher is the host of the Cash Flow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. Get Rich Education is brought to you by Ridge Lending Group, Producers Wealth, Norada Real Estate, and Total Control Financial.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Hey, welcome to Get Rich Education. I'm your host, Keith Weinhold. Savers are losers, debtors are winners. Really, how can something that sounds so absurd to most people be true? Well, those are actually the words of the greatest selling personal finance author of all time, Robert Kiyosaki. Let's unpackage this paradox. Savers are losers, debtors are winners. Now, one night recently, I was invited over to a housewarming party by my friend, Jeff. Jeff and I have done running races together for years. He had just married, so Jeff and his wife had us and a number of his friends over to warm their new house. Jeff had a lot of friends at the party that I did not know, so I ended up meeting and striking up a conversation with these two older men. One of the two men was a retired engineer, and the other one still had an active work life to some extent, he told me, as being a mutual fund salesperson, so this was about to get really interesting. Now, I often do enjoy talking to people decades older than I, and as the three of us were standing around, I asked them how a younger person like me should prepare for retirement, just kind of to see what would happen. I figured that their answer to me would be pretty predictable, and it sure was. And these guys don't know what I do. I had just met them for the first time. The first thing they told me is save money. Right after that, the other guy added, and pay off your house before retirement. Now, you probably know that the advice that they just dispensed to me is nearly the polar opposite of how I think about wise financial management and achieving a good ROI and optimizing cash flow and managing your equity well. I just sort of quietly kept eye contact with them as they told me to save and pay off my house. And next they asked me, well, Keith, what do you do? Now, it is hard to explain to some people what I do. So rather than getting detailed about that right away, I started replying to them by telling them, well, I don't have a job. In fact, I quit my job years ago because it took too much of my time. And now, just between you and me here, running Get Rich Education isn't so much a job, but it is work. It's work that I enjoy. Anyway, moving on to my chat with these two older gentlemen. Since they told me to save money, I added in that, well, I don't have a savings account, actually. And then I said, as far as paying off my home by retirement, well, I do happen to own my home, although I often do wonder whether I would be better off paying rent instead. In fact, I told him if I did move, it's fairly likely that I would become a renter and not own again. But as long as I do own, I told them, I expect to keep my mortgage balance high even into retirement age. In fact, if equity accumulates in my home, I am always quick to yank it out. That's what I told them. So by now, this was piquing some real interest in these two guys that I had just told this to. Since one of the guys was a mutual fund salesperson, I just respectfully added in that, yeah, I don't even own any stocks or bonds or anything like them. No ETFs, no mutual funds. Now, I'll just tell you here, sidebar, though that part is true, it's likely that I'll have some exposure to stocks again once the stock market feels more adequately valued. But anyway, based on what I told these two guys so far, maybe they were thinking that I just couldn't afford to be invested in stocks. But anyway, by this time, I am demonstrating to these two guys that I am financially pretty divergent from the mainstream and certainly far from their concept of financially secure. They might have even been feeling a little bit sorry for me at this point. Now, the next thing I told them, since we were on the topic of savings and debt, was just merely another fact in my life. And this one was like I completely detonated a verbal bombshell right there in front of their faces in Jeff's living room when I told them, yeah, actually, I have millions of dollars in debt that I'm frankly never going to get paid off. At this point, the two older guys might have even wondered why our mutual friend Jeff invited me over to this house party in the first place. Maybe they thought that it's a wonder that I'm not homeless, or wondered if I own a car or ever go on vacations. Well, I sure didn't tell them at any point that savers are losers, debtors are winners, but I started to explain my investor life to them without trying to tell them that they're wrong, without proselytizing or trying to get them to adopt my point of view. I think I just opened them up when I told them that, well, actually, I don't want to accumulate equity in my home because it has no return and it's actually illiquid and unsafe, and that I reinvest those dollars that aren't in my home into cash flowing real estate around the country and beyond, and that I have substantial real estate income such that I don't need a conventional day job. The millions of dollars in debt could be paid off, and in a sense, they really are paid off on my balance sheet since the value across all the properties easily exceeds the debt balance incurred, and that renting one's own home often provides them with better cash flow than owning one's own home, and so on. Now, were the two older guys dating themselves by telling me to save money, put money in a 401k, and get a paid-off home? I don't know. I guess some people would say that they're dating themselves if they're thinking of dollars as money, maybe back when there was still a gold standard. But I don't know that one is dating themselves simply by thinking that way, because there are still a ton of younger people, I'd say the majority, that think that saving and having a retirement account is the way, but no one ever got rich saving money, but many acquire wealth by investing it. And by the way, I'd like to think that I'm still too young to ever say or do something that dates myself. In fact, I did all the dating of myself back in high school because, you see, I couldn't get a girlfriend, so I had to date myself. See what I did there? Well, all right, you don't often listen to Get Rich Education for the humor, thank goodness. Yes, when I got my high school diploma at age 17, I still looked like a 13-year-old, so there was no girlfriend, and dating myself was the only option. So getting back here, savers are losers and debtors are winners is more, I guess, really sophisticated than one's conventional notions of saving and debt. When you talk about accumulating 50% of your assets in a savings account or a CD that has an interest rate that yields you a return that's 1/4 as much as the rate of inflation, that is losing. That's the losing that we're talking about here. If you have substantial consumer debt that you have to pay back yourself, it's tied to a worthless or depreciating asset, plus you have to pay that debt back yourself, and tenants aren't doing it for you, now that's losing. When Kiyosaki says savers are losers, debtors are winners, he's talking about how when he borrows money from the bank to buy a rental property, and listen, I think this is the real crux of this, okay? When you borrow money from the bank to buy a rental property, you effectively borrow money that savers have first placed into the bank. Now you just arbitrage the saver's low yield dollar into your high yield dollar. And then on top of that, you get the tenant to pay back the bank over a period of time, and you even get the property. Well, that's what I do. Savers Are Losers criticizes the practice of saving as a way of accumulating wealth. You can store your liquidity in something other than a savings account and move it along as soon as you can to get that yield and that velocity. Now, with millions in good debt tied to cash flowing real estate, why would I want to get involved with paying that down? I would only lose leverage. Tenants and inflation are both paying that debt down for me. That's pretty great. But now I do need to pay attention to that, because tenants paying down my debt for me, that actually means that it is slowly making me lose leverage too. Think about that. Now, with inflation, inflation amplifies the savers are losers, debtors are winners mantra. Look, think of it this way. Think about your best friend. Okay, let's say you've got a friend so good that they would hypothetically loan you money, which is actually the best way to lose a friend fast. But let's just say you borrow $10,000 from this great friend of yours. Well, now you're a debtor, your best friend is the lender, and you are the borrower. This friend of yours is so nice and so trustworthy of you, and so gullible and not inflation conscious as well, that they tell you that you can pay them back the $10,000 that you just borrowed in one lump sum 30 years from now, interest free. 30 years from today, in the year 2048, 2049, sticking with this hypothetical here, you are a person of your word, and you pay them back their $10,000 30 years from now, just like they asked. Well, here's what happened. At a 4% inflation rate over those 3 decades, their $10,000 just had its purchasing power diminished to $3,080. Now, can you see how savers are losers and debtors are winners? You were the debtor. You won. Remember, you are taking out interest-free loans when you buy cash-flowing real estate. Yes, I said interest-free loans. How is it interest-free? Because your tenant pays the interest. That's why it's interest-free to you. Of course, that tenant is also paying down your principal on top of that, and some cash flow on top of that yet. So it's a deal that's substantially better for you than when you struck the deal with your best friend and you had the benefit of using their $10K for 30 years. So leverage cash flowing real estate, it makes this even better for you. It's better than the deal with your best friend, or maybe it's your former best friend now that you borrowed money from him. Inflation's winners are any form of debtor, particularly governments. The losers are those with cash holdings. The losers are those with bonds. The losers are those with pension savings and welfare claimants. They're all losing to inflation. Most debtors are actually unintentional winners. They're unintentional because most debtors don't understand this inflation profiting benefit that makes them winners. That's why I practice equity harvesting from my home and from other properties. I make equity transfers, which do, in fact, position me for more leverage and more debt. At the same time, it boosts my passive cash flow. So this reinforces the velocity concept of money as well. I'm practicing keeping my money moving, that high velocity of money, like we're supposed to keep. Realize that in your own home, your primary residence, when you pay down your principal, what you're doing is you convert your cash into your equity monthly. When you convert your cash into equity that way, you've just transitioned from a higher use dollar of yours because it had been liquid into a lower use dollar of yours because now it's not liquid. It is trapped as equity. That's why a dollar of yours is not a dollar is not a dollar. Each dollar in the asset column of your net worth statement could have a different value for that very reason and for other reasons too. Now, in a rental, consider this. Consider that your tenant's cash flow becomes your equity. That's a substantially better deal. Equity that accumulates in a home, though, it's really a lot like money that sits in a ceramic piggy bank on your bookshelf, just gradually being eaten away by inflation. So instead, keep it moving, keep that velocity, don't let it get lazy. Lazy money is really just like a lazy employee. If you're somebody's boss and you've got a lazy employee, why would you tolerate their late show-ups and their 2-hour lunch breaks. You wouldn't tolerate lazy money just the same way you wouldn't tolerate a lazy employee. So it's about repositioning dead money. It's about repositioning underperforming money. You sure wouldn't keep paying a dead employee. If you put $20,000 down into your rental single-family home years ago, but now you have $50,000 worth of equity in it, you would have to ask if you would rebuy it with $50K of equity in it. You probably wouldn't. If you don't hold up your leverage ratio, then your real estate return on investment will soon approach that of a government bond. Your return on equity drops over time when properties appreciate. So in this context, savers are losers, debtors are winners. So I probably got the two older guys at Jeff's party thinking differently, if nothing else. But most people would really rather be affirmed than informed, because information challenges people and affirmation comforts people. Some people just want to hear whatever fuels their confirmation bias. Whatever fuels their confirmation bias is the easiest thing to hear. Well, now inflation is on the uptick. That's a long-term positive trend for leveraged real estate investors. But interest rates are also on the uptick, meaning that things aren't quite as good for debtors. In fact, the last time that macroeconomist Richard Duncan was here on the show, he told us why there's a positive correlation. Higher inflation means higher interest rates. So let's talk more about what higher interest rates mean to your future as a real estate investor or even as a homeowner. That's next. You're listening to Get Rich Education.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is author Kristen Tate. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. Mortgage interest rates are now about 1% higher than they were 1 year ago at this time. In fact, there have been 8 quarter-point increases over the last 3 years. That's 2% in the last 3 years. Now, among other things, these rate increases have proven to me that future rate increases expected really are going to happen. In fact, it's not just what I think. It's what the Fed has come out and said. They plan to raise rates one more time here at the end of this year and 3 more times next year. They've told us that, and likely a quarter of a point each time. So therefore, we don't have to try to anticipate the future. At least this very open Fed is telling us just what they plan on. They did not always do that. So rates could very well be 1% higher by this time next year. So we want to keep some historical perspective here. For one thing, stay mindful that over the nearly 50 years that Freddie Mac has tracked rates, which is since 1971, 30-year loans have seen that average of 7.7% for a mortgage interest rate on a 30-year, which might be more like 8.7% for a rental property. And today, you can still get a primary residence loan for about 5% and an income property loan at about 6%. When rates are rising, like they are now, investors have a sense of urgency to act and close on deals, and we expect to be in a rising interest rate environment for quite a while. That's why I have a sense of urgency to act now. It's when rates fall that investors feel the opposite way. They get a sense of complacency, not urgency, but complacency, because they feel like if they wait a few months, rates are going to be lower. Well, what else do higher interest rates mean? Well, this matters. As you know, I'm always telling you that you should regularly think about how your tenant is thinking, or about how your prospective tenant is thinking. Housing prices began to rise in the U.S. more or less in 2010 or 2011, and now interest rates have joined in alongside them, beginning their rise in 2016, 2017. Well, of course, that begins to crimp the cash flow for new buys that you make. Well, that crimps affordability for others as well. That hurts the home buyer, and especially the aspiring first-time home buyer. When renters cannot get in to buy something, well, this worse affordability, this forces them to stay in the renter pool. Therefore, that increases the occupancy rate and often increases the rental amount that you can charge as well. Yes, higher interest rates increase the demand for rent. So when mortgage interest rates go up, rents go up, although there's definitely not an immediate cause and effect. There is some substantial lag time there. There is a lag time until rents increase following that mortgage rate increase. And housing prices have risen more than wages as well. Well, that means that fewer and fewer people can form down payments to buy a house. So that's some of the good news for real estate investors with rising rates. How about more bad news with rising rates? There are some metro markets where higher real estate prices and higher interest rates have made cash flow with a 20% down payment nearly impossible, where those numbers worked 5 years ago or even 2 to 3 years ago. The best metro markets to invest in change over time. That's why we recently added 2 markets at greturnkey.com, the Tampa Bay market and the Northwestern Indiana market, which is actually the eastern fringe of Chicagoland. Returns have shrunk in some places. Let me ask you, would you invest if you knew you were going to get, say, just a 4% cash-on-cash return on a property, or would you not? If you would, maybe you're figuring that with the 5 ways real estate pays you, then maybe you still can't make a better total passive return anywhere else with a 1 to 4 unit income property. So say if appreciation on your income property slows down to, say, 4%, well, at 5 to 1 leverage, that's 20% leveraged appreciation, plus your 4% cash-on-cash return, plus your principal paydown yield that the tenant makes up for you is another 4%, plus 5% from tax advantages, plus just 3% from inflation profiting. That would still be a 36% total rate of return for you when you add up all 5 profit centers. So we're talking about investing in today's higher interest rate environment. That is your perception and your reality as an investor. Let's talk about that customer of yours' perception and reality as well here in this arena of higher prices and higher interest rates. Yes, that customer of yours, that tenant that faithfully shows up inside your brick and mortar business every day, call the rental unit and helps make up those 5 ways possible for you. This 2-minute clip from a recent CNBC broadcast is about what society thinks about renting their home versus owning their home today. It's Diana Olick and then a couple male CNBC commentators comment at the end.
The answer has suddenly changed. Rent or buy? Since the housing crash, it's been buy. Lower home prices and lower mortgage rates made the calculation pretty simple, but now both of those are sizably higher. The monthly costs of buying a home and owning a home are up 14% over the past year. This is more than 3 times the 4% increase in monthly rental costs. And all this is according to Realtor.com. So the number of local markets where it's cheaper to rent than buy is significantly higher. As of now, just 41% of the nation's population lives in a county where the median income family can afford to buy a home. Looking at the numbers for July, buying a home was cheaper than renting in just 35% of the nation's county. Compare that to 44% a year ago. So let's get local. It is much cheaper to buy than rent still in Detroit, Baltimore, Fayetteville, North Carolina, and in Madison County, Illinois, which is just next to St. Louis. On the flip side, cheaper to rent in most of Northern California and, of course, the New York City area, particularly Manhattan and Brooklyn. And renting is now a better investment than buying for the first time since 2010. That, according to research from Florida Atlantic University. That is, you make more money taking the savings from renting and reinvesting it than you do through owning and seeing your home equity increase. So, rent, guys. Sell and rent. Maybe.
Yeah, I don't know how long we can count on that, Diane. I mean, your savings got to go somewhere where it grows, but stock market can't go up forever, right? Who knows?
That's a problem. It's backward looking, right? You can invest it in something else. Maybe invest it back in, real estate income properties.
Yeah.
REITs.
It's normal, right? Except for 2008, housing is an early cycle sector. Interest rates are low, incomes start to grow. So in an early cycle environment, you can buy. But in later cycle, interest rates go up, home prices go up. It's harder to buy. The exception was 2008 when we had these artificially low interest rates, which made everything so affordable. But what we're seeing is actually quite normal.
So that's evidence that more people think it's wiser to rent their home than buy their home, as you heard it there. The monthly cost of home ownership has risen 14% in the last year, but rents have only gone up 4% in the last year. And what a comment from CNBC's Diana Olick there, suggesting that it's increasingly wise to be a renter of your own home because it's less costly than owning your own home, and then reinvesting that difference in income properties that you rent to others. Dang, Diana really gets it. That might be the smartest comment I've ever heard on that show, and I don't often give a shout out to CNBC. That was just really interesting wording there as well, when they use the word investment there in that clip, about how people feel that renting their own home is a better investment than buying their own home. And that is good news for us as real estate investors that want lots of renters and rental demand. Now, just last week in the Wall Street Journal, an article was published, and it was titled, "Big Jump in Americans Saying Renting is Cheaper Than Owning." And then the subtitle reads, "Freddie Mac data shows 78% of people now say that renting is more affordable than owning." So this is perception here. And gosh, I just never would have thought that many people, 78%, would say that. But here's what the article says. I'll go on to read it. More than 3/4 of Americans now view renting as more affordable than owning a home, the latest sign that rising mortgage rates and higher home prices will continue to pressure home sales. Some 78% of people now say that renting is more affordable than owning, according to survey data released Tuesday by the mortgage company Freddie Mac. That is up 11 percentage points from only 6 months ago. Now, I'll come off from reading the article for a moment. So the translation is that 6 months ago, 67% of people felt that renting was more affordable than owning. And now, remarkably, 78% say this. So back to the article. The survey also indicates that demand for for-sale housing could remain soft in the coming months. Some 58% of renters now say that they don't currently have plans to buy a home. That's up from 54% in February, according to Freddie Mac. Demand for rentals swelled after the recession as millions of families lost their homes to foreclosure, and tight credit made it difficult for young people to buy homes. Rents rose by double-digit percentages in many cities, and the share of families who couldn't afford the rent swelled to record highs. Meanwhile, home prices plummeted, and for those who could qualify for mortgages, that was a great time to buy, but this year that dynamic has reversed. Rent growth has slowed in line with inflation in the last few quarters as new rental supply hits a 3-decade high. At the same time, home prices continue to grow significantly faster than incomes and inflation, and mortgage interest rates have risen nearly a percentage point from the beginning of this year. That has made it significantly more expensive to buy a home. David Brickman, president of Freddie Mac and the head of its multifamily division, cautioned that renting remains unaffordable for many families. But buying lately has become even more unaffordable. It's the worst of both worlds, Mr. Brickman said. 2/3 of renters today say they have had difficulty affording their rent at some point in the past 2 years, according to the Freddie survey. Nearly 9 in 10 renters in what Freddie deems essential fields like healthcare and education say that they have had significant struggles to pay rent during the past 2 years. Mr. Brickman cautioned, and again, Mr. Brickman is the president of Freddie Mac, and he's the head of its multifamily division. He cautioned that if more people decide to continue renting, that could eventually reverse the current dynamic and make rents once again begin to rise quickly. And then the article finishes with Mr. Brickman saying, I do worry that it may be short-lived, that it's some reaction to rising rates, but the underlying demographic trends are not slowing at all, he said. That's the end of the Wall Street Journal article published just last week. So an interesting article there. I'll be sure to put that in the show notes. Just remember that the national homeownership rates peaked in 2004 at 69%, and the rate bottomed out at 63% in 2015, and today they're only slightly above that low at 64%. So that should get you caught up on the state of the real estate market from the perspective of higher prices, higher interest rates, a little bit higher inflation, but still not all that high, and more people desiring to rent from you than to own their own home. You are going to live in an ever-shifting real estate market throughout your life. And of course, I want to remind you of a real positive with this in a long-term view. And all of it comes down to your ROTI again, your return on time invested with real estate. Look, your ROTI goes up throughout your life. It gradually increases as you're constantly teaching yourself lessons, and you're getting the lessons faster in life the more that you act. 10 years ago, people learned that buying real estate for speculative capital gains can backfire badly. Well, then you're going to get a better return on time invested going forward because you'll forever tell yourself, well, I wouldn't invest solely for appreciation again. At some point, your set of experiences and accumulation of time in real estate will probably tell you, I would not self-manage again. Maybe you'll learn, I wouldn't hire a property management company like that one ever again because I can see that they make extraneous work for themselves in my property and maintenance costs rack up needlessly. Maybe your return on time invested will increase as you learn that using 5% of your gross rent amount as a long-term maintenance expense number is going to be too low. Or you wouldn't use a home inspector that's biased like that and doesn't want to beat up on the provider or the seller side enough. Your ROTI increases throughout your investor life, and that's one rate of return that's really pretty predictable. I have got to tell you that I really appreciate that you value listening to me every week. You're listening to someone that is doing it, that's actively investing in real estate, and sometimes I'm investing right alongside you. Learn from somebody that's doing it. I had a lower middle class upbringing in Appalachia, USA. I do not own an economics degree, no MBA, no business degree at all, nor does my family. I have no real estate or entrepreneurship in my family background either. My degree is a bachelor's degree in geography and regional planning, and I actually dropped out of graduate school about 1/3 of the way through there from Westchester University in Pennsylvania. I think most importantly, I am a 16-year investor, and I spent 5 of those self-managing my property. Oh gosh, that is time I'll never get back. And then I realized that the real dollars are made by understanding economic concepts specifically applied to investment real estate. That's the major wealth producer. I am not replying to tenant requests and fixing broken stuff myself. The return on time invested would simply be too low. And I'm happy to say that I will be back on the Forbes Real Estate Council in 2019, next year, and continuing to write articles for Forbes. Don't forget to turn your clocks back 1 hour this weekend. Gosh, daylight saving time is some nonsense. Even the name itself is a bit offensive. They named it daylight saving time, but in the history of the world, it has never saved 1 second of daylight. It needs to be called what it is, daylight shifting time. Daylight is only shifted, not saved. Nothing has been saved, but our time has been wasted. It gets wasted twice a year. Maybe some good news about DST this year is that it means that we will all have 1 more hour to spend this weekend at the New Orleans Investment Conference in New Orleans, Louisiana. Yes, in a few days, I'm leaving one great American city, my hometown of Anchorage, to go to another great city, New Orleans. I hope to see you there for a little meet and greet this coming Friday and this coming Sunday at 11 a.m. each morning at the Agronosotros booth number 111. And it's pretty likely that I'll lift weights or go running outdoors a couple mornings while I'm there, so maybe you can join me with that as well. If you're listening to the podcast version of Get Rich Education, be sure to subscribe on your podcatching device by touching the subscribe button. That's how you will be sure to never miss any episode. I would be grateful. I'm your host, Keith Weinhold. See you in New Orleans. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
As America's third largest city, Chicago, Illinois has big economies of scale for real estate investors. But there are problems with investing in highly taxed, fiscally strapped Illinois. You can beat it when you invest in Chicago land, staying on the Indiana side of the state line. Your property tax on a median Indiana home is less than half that of an Illinois property. Forbes ranks Indiana as one of the top 10 states to do business. With typical rents at $1,250 and purchase prices at $125K, Northwest Indiana numbers work. Learn more and connect with the turnkey provider at GetRichEducation.com/Chicago. That's GetRichEducation.com/Chicago.
71% of Americans aren't saving enough for retirement. It's going to get worse as people live longer, and you need to start thinking differently. But you can't lose your time. Real estate is the investment vehicle that's made more ordinary people wealthy than anything else. Keith Weinhold of Get Rich Education is host of one of America's top investing shows, Disrupting Wall Street. He's an international best-selling author, a writer for Rich Dad Advisors, and has been an active income property investor since 2002. He has created thousands in passive monthly income for countless followers, and now he has a free book, The 7 Principles for Creating Wealth in Your Life. Get your copy now at GetRichEducation.com/book. That's GetRichEducation.com/book. Because invest in what produces income for you now and later. Sign up now at GetRichEducation.com/book.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.